Welcome back to Amsterdam. It is day 2 of the Morningstar Sustainable Investing Summit 2024. I'm joined by Catalina Secreteanu, Managing Director at Morningstar Sustainalytics, and she just led a panel on the future of ESG. And I think there were two main competing ideas on the panel of whether stewardship or regulators enforcing transition is the most effective lever at making companies more sustainable. And I think the audience in the poll actually prized stewardship higher than hard targets. My question to you, since this is your field of expertise, is: are we good enough at measuring the efficacy of stewardship? Because someone might be tempted to see hard targets as something that is more measurable and more enforceable.
I think it's a good question. What I would say is that it's a difficult one. Clearly, in the context of the session that I've just moderated, the focus was very much on what is the appropriate path to help us achieve real world outcomes if we think of that as the future of ESG. So on the one hand, the asset owner representatives was really arguing for systemic level stewardship. And I think kind of the point of clarification there is that she was advocating that engagement at a government level and government supporting some of the long-term objectives is a really important path, that stewardship at a company level done by investors is not sufficient. Whereas I think the other perspective was that the climate crisis ahead of us is so urgent that exclusively relying on stewardship as the most effective tool will not get us there fast enough. I think what's challenging perhaps is that the efficacy of stewardship in the context of this conversation was assessed through the lens, are we achieving real world outcomes fast enough? And I think there were some figures that were presented in the debate that clearly showed that whilst we are, at least at artificial level, achieving some portfolio level decarbonization, very little of that is actually achieved through real world outcomes, through truly I would say kind of transition. So for example, we're only achieving it through the perception that companies are reducing carbon emissions rather than companies, for example, retiring old technology and investing in new technology. So truly investing in new capex. So for the conversation today, I would say the bar or the threshold for are we good enough at assessing the efficacy of stewardship was very high, and that is that it was really looking at it through the lens of, is it achieving real world outcomes? And I think that what we are likely to see, if we are or not, is more through the lens of incremental change. But I thought it was an insightful conversation. It's very hard to give a definite answer.
Right. Of course, in the past year or so, we've seen rapid outflows from the more dark green funds, and there's probably going to be some consolidation between these funds. Do you see a risk that there might actually be less pressure on company management and actually less effective stewardship as a result of that?
I don't think so. Look, generally there's, at this moment in time, and obviously it's also a cycle in the market, is that we're seeing quite a distinction between the state of the industry as it pertains to the institutional side of the market. So that is asset owners giving their asset managers mandate and asking them to integrate ESG in a certain manner or take into account climate risk, compared to what we see in the retail and wealth space with sustainability labeled funds, where indeed we have seen some fluctuations. Some of the research by my colleagues suggests that some of these asset flow fluctuation has been driven by underperformance, some of it determined by energy prices, and some of those sustainability labeled funds primarily designed for a wealth and retail space are indeed going through challenging times in the market, and I believe that it is just the cycle that we're into. However, if we think about the institutional side of the market, and that is again going back to the debate, what asset owners with significant assets are asking of their managers through segregated mandates, it's a very different story. And that's where it is through that lens that I believe that the pressure on companies to think about what is the financial risk that they are exposed to as they think about their transition, and how will they achieve the 1.5 degree target that many of them has set, will continue to be there.
Pressure's not going away. Well, it's good to hear, Catalina. Thank you for joining me. For Morningstar, I'm Lucas Strobel.